Writing options can be an absolutely fantastic way to generate income. But here's the thing. There's a silent partner in all of your trades, and they often take the biggest cut. Yep, I'm talking about the tax man. So many traders focus only on gross profits, and then they get this gut punch of a surprise when they see how much of it just vanishes. Today, we're going to fix that.
So, let me just ask you straight up. Are your hard-earned option profits getting overtaxed? I'm willing to bet that for the vast majority of you listening, the answer is a big, resounding yes. And it's probably not your fault. It's just how the tax code is set up by default.
All right, so here's our game plan. First, we'll break down the core tax problem every option writer faces. Then, we'll look at the real-world damage of what I call the default tax trap. After that, the fun part. We'll introduce the single most powerful solution out there, Section 1256. Then we'll shift gears and learn how to navigate the minefield of regular equity options. And finally, we'll put it all together into your very own tax-efficient playbook. Okay, let's start with the fundamental problem here. You're going to have to understand that the U.S. tax system, whether it means to or not, creates this built-in headwind that pushes against most option writers right from the get-go. And here is the absolute crux of the issue. When you sell an option and it expires worthless, or you buy it back for a profit, that gain is almost always treated as a short-term capital gain. And here's the kicker. It doesn't matter if you held that position for 2 weeks or 11 months. It gets taxed at the very same high rate as the income from your day job.
So, what does this tax trap actually look like in terms of, real money? The difference is, well, it's pretty staggering when you see the numbers laid out.
Just take a look at this. The gap between these two columns is massive. Let's say you're a high-income earner. You're in that 35% bracket. A short-term gain from one of your option trades gets hit with a 35% tax. But a long-term gain, say from selling a stock you held for over a year, that's only 15%. That is a huge difference in your bottom line. In the highest tax bracket, this gap balloons to a staggering 17 percentage points. Think about that. You can look at it as an automatic 17% penalty slapped onto your profits, just for choosing what the IRS considers the wrong kind of trade. I mean, that's a performance hurdle that is just incredibly tough to clear year after year.
But what if there was a way to completely sidestep that penalty? Well, there is, and it's time we talked about the closest thing we option traders have to a tax cheat code, Section 1256 contracts.
You see, the IRS has designated certain financial products for some special, and I mean very favorable tax treatment. For us, the most important ones are options on broad-based indexes. Yeah, we're talking about the big ones, like options on the S&P 500 index itself, ticker SPX. And this right here illustrates the point perfectly. Look, you could trade options on SPY, the super popular ETF that tracks the S&P 500. Your profit? 100% short-term gain taxed at that high rate. Or you could trade options on SPX, the index itself. You get almost the exact same market exposure, but you get a much, much friendlier tax rate. Same trade, different tax. It's that simple.
And this is all thanks to the magic of what's called the 60-40 rule. It's incredible. It doesn't matter if you hold a Section 1256 contract for a day, a week, or a month. The IRS automatically says, okay, we're going to treat any gain or loss as 60% long-term and 40% short-term. This creates a lower blended tax rate that is an absolute game changer.
Let's put some real numbers on this. Say you make a $15,000 profit. A trader in that 35% bracket would pay over $5,000 in taxes on an SPY trade. But by making the exact same trade on SPX, that tax bill drops to just $3,900. That's a savings of $1,350 that goes directly back into your pocket. That's your money, not the IRS's. Oh, and it gets even better. The benefits don't stop there. Section 1256 contracts are also exempt from those super frustrating wash sale rules and the incredibly complex straddle rules, which we're going to get to in a minute. You can even carry back losses for up to 3 years to offset gains you made in the past. It really is a trifecta of tax superpowers.
But of course, we can't always trade index options. Sometimes you have to trade options on individual stocks or ETFs. So what happens then? Well, this is where you have to switch from playing offense to playing defense, and you have to learn how to carefully navigate a minefield of rules.
So the first trap you need to know about is the straddle rule. If you're using spreads, like an iron condor or a credit spread, you've got a straddle. And the rule is basically this: you can't book a loss on one side of your spread while you're still sitting on an unrealized gain on the other side. The IRS makes you wait. They defer that loss until the whole position is closed out.
Now, there is a safe harbor for one of the most popular strategies out there, the covered call. If your covered call is what they call qualified, it isn't considered a straddle. But, and believe me, this is a big but, the QCC has its own set of very tricky traps that have to do with your stock's holding period.
To be qualified, a covered call has to pass a few tests. The big one, the one that trips most people up, is that it must have more than 30 days to expiration when you write it. This means all those popular weekly covered calls you might be selling, they are automatically non-qualified. And it also can't be too deep in the money. And this slide right here shows you exactly why this is a minefield. Seriously, look at this table. If you're trying to get a long-term capital gain on your stock, an out-of-the-money qualified call is fine. Your holding period clock keeps ticking. But look at that second row. Write an in-the-money qualified call, and that one-year clock, it gets paused for as long as the option is open. Now for the real killer, that bottom row. Let's say you've held the stock for 11 months, you're almost there, and you sell a weekly covered call against it. Remember, that's a non-qualified call. The result? Your 11-month holding period is completely erased. Poof! It resets to zero. That potential long-term gain is gone, and the one-year clock starts all over again. Ouch. The final landmine to watch out for is the wash sale rule. It basically says you can't claim a loss on a trade if you buy back a substantially identical security within 30 days. The huge problem for us option traders is that the IRS has never clearly defined what substantially identical actually means for options. Is rolling to a different strike or expiration okay? Most brokers let you do it, but it's a gray area the IRS could decide to challenge. All right, so after walking through all of that, how do we actually put this together into something useful? Well, it all comes down to a clear, actionable playbook with one prime directive. Here it is. This is your tax-efficient playbook. Number 1, and this is the most important, prioritize Section 1256. Trade SPX, not SPY, whenever you possibly can for that sweet 60-40 rule. 2, manage your covered calls with extreme care. You have to understand how they can pause or even nuke your stock's holding period. 3, respect the straddle rules. Know that you often have to close an entire spread just to realize a loss on one part of it. And finally, harvest your losses, but do it carefully to stay out of that ambiguous wash sale territory. So I'll just leave you with this one question to think about. Anyone can build a strategy to generate a profit. The real question is, have you built your strategy to generate the maximum after tax profit? Because at the end of the day, let's be honest, that's the only number that really matters.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.